here today. Today we have a great topic on just back to the basics here at the end of the year. We only have a few things left for you guys this year, so we appreciate you guys joining on. I'm going to give a little time here just to let the attendees join. I see the number going up steadily. So again, those joining right now, thank you for your time. Thank you for joining us today. We hope you guys are having a great week. Today we have drilling down on the fundamentals of wealth building with Jo Ficca, and we'll let her start here soon shortly. But before we do, I want to go over a few things with you guys. Maybe new to Quest, may not be new to Quest, but make sure you guys know what we have upcoming for you guys. As it's the end of the year, we only got a few events coming up now at the end of December. I think about 3 more. Right. I do want to point a specific attention to our networking event. That's going to be tomorrow. That'll be the last one of the year. Right. So if you guys are looking to network with like-minded individuals on a webinar platform where you can pitch deals, listen to investments, and see what's out there for you guys to just, bring more deals to your self-directed IRAs or to pitch investments. Right. This is a fantastic opportunity. Something I will mention, myself and Steve will be on the chat box, and I have Steve right now that will be dropping down the links to these events I'm mentioning in our chat box. So keep looking at the chat box, use that for questions, etc. The other 2 classes, we have 2 more for the rest of the year. And then we already have some of the ones in January. So if you want to plan ahead, you can go on our webinar page. I'll have Steve drop the link for you guys as well to look at what January events we have in store for you guys already. And then that continue to get updated. One thing I also want to point out is our YouTube channel. Our YouTube channel is growing every single day. And we have a ton of playlists for you to look at for those that are looking for basic topics, quick 5-minute videos on what you can and cannot do with IRAs or real estate investing in general, and to some more complex kind of topics that we have on there as well. Steve just put the YouTube channel link right there. So subscribe, take a look at it, send it to friends, whatever you guys need. As always, you guys know we're available just a phone call away. Our website has a chat box feature. Please use it. And then without further ado, I want to get this started. I'm going to introduce Jo Ficca. So Jo's been with us for 6 years. I'll let Jo kind of introduce what she does here and everything, but she's fantastic. She's been with Quest for a long time, longer than I have. So she's a wealth of knowledge. And Jo, take it away.
Awesome. Thank you so much, Juan. So as Juan said, my name is Jo, and thank you everybody for joining us on this presentation this morning. Before I go into the actual presentation, I actually wanted to share an interesting statistic that I read before coming on here, and that was that only 2% of all IRAs are self-directed. However, 25% of all IRAs valued over 5 million are self-directed. So it's really amazing to think about how much you can actually create with self-directed IRA accounts. So let me go ahead and share my screen and let's get to our presentation. So today I'm going to kind of be going over the basic foundations of self-directed IRAs, the different types of accounts, their tax advantages. And then I'm going to wrap it up with a case study to show you how a self-directed IRA can really make a dramatic difference in your overall wealth. A little bit about myself. I'm a certified IRA service professional and the account services manager here at Quest Trust. As Juan mentioned, I've been here for 6 years, and through my journey at Quest, I've had the great advantage of being able to see many different types of investments made by people from all walks of life. As the account services manager, I manage the departments that will help you with establishing your account, transferring your funds in, depositing the funds into your account. And then I also manage our inherited IRA department and our Dallas office. In my free time, I'm also a real estate agent, and I really love learning about the commercial real estate world. So, who is Quest Trust Company? We are the fastest growing self-directed IRA in Texas with our corporate office in Houston, and we also have an office in Dallas and Austin. We hold $2 billion in non-traditional IRA assets with 20,000 clients across the US. We have 110 employees with 28 certified IRA service professionals because at Quest, we believe that an educated client is going to be our best client. So we make sure that not only are you guys educated, but our staff is properly trained and they're able to assist you with any questions that you have throughout your investment journey. We have fast and world famous customer service and no expedited fees. We know that time is money in the investing world, so we like to process your stuff as quick as possible within that 1 to 2 business days when everything is good to go. So before we go any further, I just wanted to put our disclaimer out there. Quest does not provide any tax, legal, or investment advice or endorse any products, services, or investments of any type. This presentation is strictly for educational purposes. If you have an investment that you want to make, we definitely suggest that you consult with your attorney, your accountant, your financial advisors, anyone who can help you do your due diligence. And make sure that what you're investing is something that's going to benefit your IRA the most. So what will we learn today? We're going to go over how to use a self-directed individual retirement account to increase your personal wealth. We're going to learn how to use other people's IRAs to fund your investments. And then we're going to find out where we can have all this information and education for you. So what is a self-directed IRA and why should you have one? A self-directed IRA is really just a marketing term used to describe what we as a custodian hold and the types of IRAs that we have. Nathan Long, our president of our company, likes to say an IRA is an IRA is an IRA. And what that basically means is that an IRA that you're going to hold here at Quest is going to be the same as an IRA that you're going to hold at Charles Schwab or Fidelity. The only difference is what the custodian will allow you to invest in. So at a company like Charles Schwab or Fidelity, you're going to invest in more traditional assets like stocks, mutual funds, bonds, but with a company like Quest, you're going to invest in privately traded assets like real estate, promissory notes, private companies, those types of things. And the cool thing is that even though you have one account here, you don't have to close your other account there. A lot of our investors will actually have different accounts at different custodians, and then they'll find their investment. They'll be investing their funds in the stock markets. And when they find, like, let's just say a house that they want to purchase, they'll transfer the funds from their account over to Quest, make that investment, fix it up, or once they start getting the returns, since the account isn't making any, the funds aren't making any interest over here, they'll transfer it back over to the other custodian, invest it over there. And then when they have another deal that they're going to do, they'll bring it back over and then they'll keep doing that over. So you can have accounts in both different places. It's actually really good, which brings us to the benefits of having it, which is the first one, which is going to be diversification. So again, having your funds, especially in a world like today with COVID, where everything is so up and down, you don't really know what's going on. It's good to have your funds and your wealth diversified, right? You're invested in the stock markets, but you're also invested in real estate. So maybe if the market is down, you could still potentially be getting those investments, rental income from your rental property or other things like that that you have in your retirement account. Another benefit, of course, is going to be those tax savings, which are so important when you're trying to build wealth, is to get those tax savings and benefits from these types of accounts. We also have social investing, which is one of my personal favorites, because with social investing, when you're investing in the stock markets or those type of things, you don't really know where your funds are going. But with social investing, you're kind of investing in the community, because let's just say I, as someone who's lending, I could lend it to an investor who is going to purchase, let's just say, the ugly house on the block. And they're going to take that, they're going to fix it up, they're going to purchase the property, they're going to hire people to come fix it, they're going to purchase the materials locally, and then once it's all fixed up, they're going to move a family in there and they're going to help build the American dream. So with a self-directed IRA, not only are you growing wealth, you're actually able to invest in your community and see the place look much more beautiful with that type of investing. And then last but not least, we have investing in what you know best. We all have skills and knowledge that we can apply to our investing. We might not know that much about stock markets or mutual funds, but maybe you already know about real estate, or you're familiar with how a private company works. These are all things that you can take your knowledge that you use on an everyday and start applying it to your retirement account. So if you know about oil wells, or maybe you know about renting out medical equipment, those are all things that you can do in your retirement account. It's actually quite fun when you start to do things that you know a lot about and you have that knowledge on a daily basis. So what types of accounts can be self-directed? Here at Quest, there are 7 different types of accounts that we have, and we break them down into 3 different categories. So first we have our personal accounts, which are the traditional and the Roth IRA. Did you know that a traditional IRA is actually the more popular type of account? However, a Roth IRA receives more regular and catch-up contributions than a traditional IRA. The Roth IRA is actually one of the cornerstones to building wealth, and I personally believe that as soon as you have qualified earned income, you should definitely open up a Roth. Contributions are going to be after tax. So you're not going to get a tax deduction. However, when you invest your money, it starts to grow, and all of that will grow tax-free. The key benefit of a Roth IRA is the tax-free withdrawals when qualification requirements have been met. When you reach the distribution age of 59 and a half and had the Roth account open for 5 years, distributions come out completely tax and penalty free. All the money that you're reinvesting will continue to grow completely tax-free. So what an incredible advantage this is for you to be able to build wealth in this way. This is why these accounts can also be used to build generational wealth, as a Roth will grow tax-free for your life and can continue to grow for the beneficiary's lifetime, at least 10 years, and sometimes in some cases even longer than that, depending on who you left it to. And the cool thing about a Roth is that you can always take out contributions tax-free and penalty-free. So of course, you want to use those, the funds that you're contributing for investing. However, if you ever needed to take that out, you could always take that out. So this is a popular account, especially for the younger generation, for saving. And then we have our traditional. So as I mentioned, is one of the more popular types of accounts. And this is because if you have an old 401k, 403b, or other employer-sponsored plan, and you receive that you get from when you're employed, if you have separation of service and you don't necessarily want to take those funds, take a distribution, you can actually roll those funds to a pre-tax account like a traditional and continue to grow the account and continue to get the tax advantages from rolling from the funds to a pre-tax account, because rolling the funds will not incur taxes. When you have a pre-tax account, the contributions are going to be tax deductible. So you get to write those off, and then the account is going to grow tax deferred. When you reach distribution age of 59 and a half and you start to distribute the funds, you will be taxed, as you haven't actually paid taxes on the funds. The idea with a traditional is that once you reach retirement age, you're going to be in a lower tax bracket at that time in your life. So when you have to start paying taxes on that, it will be a little bit lower. Both of these accounts can be really helpful if you're trying to grow your wealth, especially if you're wanting to get a tax deduction, or if you really want to have your contributions start growing completely tax-free. The cool thing about these types of accounts is that you don't have to choose between one or the other. You can actually move funds from a traditional IRA to a Roth IRA and what is called a Roth conversion. So with a Roth conversion, you can move the funds from a traditional to a Roth, though this is going to be taxable. So I would definitely suggest you consult with your CPA if this is something that you want to do, because when you do the Roth conversion, you will get taxed in the year that you did it. However, let me give you an example so you can kind of see what a difference is with these two different types of accounts. So let's just say I had $100,000 in my traditional IRA and I purchased a property, fixed it up, and then I sold the property for $200,000. When it came time to distribute those funds, I would have to pay taxes on that full $200,000, as I've never paid taxes on it before. Now, if I did that same investment, but this time I did a Roth conversion and took the $100,000 and put it into my Roth IRA, I would, of course, have to pay the taxes. That $100,000 would get added to my adjusted gross income on the year that I did the Roth conversion, but now the money would be in my Roth. I paid taxes on it. Okay. So I did the same investment. I had that $100,000 and I fixed up the property and then I sold it for $200,000. The growth of the $100,000, I would not have to pay taxes on. And when I reached 59 and a half and had the account open for 5 years and I wanted to start taking distributions, I wouldn't have to pay taxes on it, as I've already paid taxes on the $100,000 I moved over, and the growth in the Roth is completely free. So it's tax-free. So the question you really want to ask yourself and your CPA is, Do I want to pay the taxes now, or do I want to pay the taxes later? Either one could be better for you in this time of your life. So definitely, I would suggest checking out our Roth Conversion class if this is something that you want to do, and educate yourself about how to do a Roth conversion and make sure you're doing the right thing, because it is important. So next we have our employer plans. Employer plans are going to be really powerful plans. And I'm not going to spend a lot of time on them because these plans can have a class all in themselves, which we actually do have online. The important thing to know about these types of accounts is that they're really powerful, especially for people who are self-employed individuals. The contribution limits are going to be tax deductible, and these types of accounts allow for a much higher contribution. So with a traditional IRA, where your contribution will be $6,000 to $7,000 max, depending on your age, with some of these employer plans, you could potentially contribute up to $57,000. So these are very powerful accounts, and they can be very powerful tax savings if you're going to be self-employed. Again, we have a class online. If you want more in-depth knowledge about employer plans, I would definitely suggest checking that out. And then if you have further questions or you're wanting to open up a 401k, call and ask to speak to one of our IRA specialists. They will actually have a full consultation with you, and they'll go over every single thing that you need to know before you actually open one of these plans. Last but not least, we have our specialty plans, which are super great as well. We have our Coverdell Educational Savings Account, which is a great type of account for those of you who are trying to save for your children's education. An ESA contributions are not going to be tax deductible, but like a Roth, with the amounts deposited, it can grow tax-free until withdrawn. With distributions, with this type of account for qualified educational expenses, those are going to come out completely tax-free. So you can potentially be paying for things like your child's tuition, their room and board. If your kids are doing distance learning right now with COVID, you could be paying for your internet, the laptop you have to pay for, the headphones, all those kinds of things that you would normally pay out of pocket. If you had this type of account, you could already be paying those expenses tax-free. This account, you can pay for your kids' expenses from birth all the way until the age 30. And if your kids are very young, this can be a great plan for them and for you to start using for investing. A cool thing about this type of account is you don't have to be the only one making contributions to this account. We a lot of times see these accounts as like gift accounts from grandparents, because grandparents or relatives can actually make contributions to your child's educational savings account. Even though these contributions are going to be smaller with an ESA, you can partner them with other accounts and you can start making your earnings, which can go back into the account. And then already you can start withdrawing them to start paying for those educational expenses. Last but not least, we have our health savings account, which is the best of both worlds and is an account that I personally think everybody should have, because of course we all have health expenses in our lives, no matter how old we are. Contributions are all going to be tax deductible, and qualified distributions are going to be tax-free. So health expenses like glasses, dentist, acupuncture, medicine, those types of things you can be paying with your health savings account. And the cool thing about this type of account is even if you don't have the funds in the account at the time the medical expense was incurred, as long as the HSA account was established, you can reimburse yourself later when you actually have the funds in the account. You just got to keep those receipts. I'll give you a really cool example. Nathan Long, our president, he, at the time, his wife needed to have a very expensive medical procedure, and he didn't have the money in his HSA at the time. So he paid for the expense out of pocket, and he kept the receipts and continued to invest the money that was in the account. And then a couple of years later, when the funds were available, he was able to reimburse himself with a tax-free qualified medical distribution and use the fund to purchase an engine for his plane. That was his little toy at the time. So that was a really cool thing that you can actually do with your account. He still had to pay the expense, but he was able to reimburse himself later. So these plans are great because instead of paying for everyday expenses with money that you're taxed on, you can begin paying for expenses like these completely tax-free. And over the course of your lifetime, if you begin paying for your health expenses or your children's expenses with tax-free money, overall that can have a lasting effect over on your wealth, that it can really make a dramatic difference. So what types of plans can be self-directed? Well, all of the above accounts can be self-directed individually, or they can be partnered together. The important thing to remember is that it's not you who's purchasing the investments, it's the IRA that is going to be purchasing the investment. So the buyer isn't going to be you, it's going to be your IRA. So the vesting for your investments are going to read Quest Trust Company FBO, which stands for the benefit of, your name, IRA, and then account number. So your IRA is going to be the one that's going to own the investment. It's going to get the tax benefits, and the money's going to go back into the account, and it's going to continue to get those benefits. Multiple people can partner together with their IRAs, and it doesn't necessarily have to be just IRAs. You can have an individual also partner with an IRA as well. It just depends on what you want. So the IRA is going to take ownership to the deal. Partnering is really great, especially if you have like smaller types of accounts. Like in my previous example with Nathan's HSA, he was able to partner that account with the Roth and several other different types of accounts and create what we like to call buckets of money, different allocations of wealth that you could be using for yourself, that your investments can be your investments will start to grow, and then you're going to get those returns, and the proceeds are going to go back into the account that are invested in equal proportion. And then you're going to begin to have money that you can start paying for things tax-free that you were previously paying for with taxable money. So there are lots of great things and incredible benefits that come with using self-directed IRAs. However, there are some things that you should know and when you're using these types of accounts. Nothing that you should be scared of, but something that you should definitely be aware of and should, of course, be taken very seriously, as if you do one of these investments in your IRA, that's a prohibited transaction. It doesn't just affect your investment, it affects the entire account. So what are these restrictions? We have our people restrictions, our transaction restrictions, and our investment restrictions. So our people restrictions, there's a group of people that are disqualified people who cannot benefit from or enter into transactions with your IRA or other plans. In other words, there's a group of people that are prohibited, that you're prohibited from doing very specific things with. That first person is going to be you. You're prohibited from benefiting from your IRA. So right now you're probably thinking, but it's my IRA, we're one and the same. I'm the one who's funding it. I'm the one who's finding the investments. I'm the one who is putting the money in there. However, your IRA is for your retirement. So the IRS says that you cannot be benefiting from your IRA right now. So to explain this, we like to call your IRA Mr. IRA and you. And your IRA and you are prohibited from doing very specific things together. Consider it like this. If you and your LLC, you have you and your LLC, are you guys one and the same? No, there's you as the individual, and then you as the LLC, then there's the LLC, which is a separate entity. So it's exactly the same when we're talking about IRAs. Your IRA is going to be separate from you. You as the individual, the account holder, the fiduciary to your account, you're not allowed to do very specific things with the IRA. And then there's this list of disqualified people that you should memorize. I'm kidding. No one wants to memorize this chart except our IRA specialists, who actually do, and who you should definitely call if you have questions regarding this chart. But with that being said, we did come up with a way that's much easier for you to remember. So the disqualified people are firstly going to be you, your spouse, your lineal ascendants and descendants, and their spouses, and any companies those people own, control, or are managed or are highly compensated by. So let me say it one more time. So it's going to be you and your spouse, your lineal ascendants and descendants, so your parents, your grandparents, your children and grandchildren, and their spouses, and any companies they own, control, manage, or are highly compensated by. These are the people who you're prohibited from doing very specific types of things. And that brings us to our second category, which is prohibited transaction restrictions. The disqualified people cannot buy, sell, trade, loan, or extend services or benefit either directly or indirectly from the IRA. So kind of let's break this down a little bit and go into what each one of these means. So let's take buy and sell. Let's just say I, Joe, a disqualified person from my IRA, let's say I owned a house right now that I use for rental property, and I just discovered about retirement, self-directed retirement accounts, and I think, perfect, let me move this rental property into my IRA. That way I can start benefiting from it and getting that cash flow going into my IRA completely tax-free. Could I do that? I couldn't. I could not sell a house that I own and now put it in my IRA, as I am a disqualified person. When we trade, like let's just say I have a rental property now and it's in my IRA, and my parents see it one day and they go, oh, I would like to work out a deal with you so I could purchase this from your IRA. I couldn't do that because my parents are my lineal ascendants and they couldn't buy that property from me. The same thing goes with loaning. If my son was starting a company, I would not be able to loan those funds to him from my IRA. I can't extend a service, so I wouldn't be able to go and fix my rental property that belongs to my IRA by myself. I would have to have somebody else do it. I would have to hire someone to do that. And direct or indirectly, let's just say my son moves to California and he's going to college there, and him and his friends need a place to stay, and I've got like a rental property. I couldn't have my son live there and pay me the rent because that would be me directly benefiting from that. The end goal of an IRA is that one day you're going to be able to retire off of it. So while the IRA is active and investing, you're not supposed to be getting some type of personal benefit from it right now. Your benefit is going to come when you reach the age of retirement. That's your benefit. You can't transact with those people, but two disqualified people can partner together like we saw a few slides ago. So they can have, as long as your IRAs are on the same side of the fence, you can partner your IRAs together. So why are these people disqualified? Generally, the reason why these people are disqualified is because that's generally how we pass down wealth. Your wealth usually goes down from your children, your grandchildren. It goes to your direct family. That's why these people are prohibited from benefiting from your IRA. You'll notice that your cousin or your brother, your uncle isn't on that list because that's not usually how we see wealth get passed down. Again, we do have a class online. If you have more questions about prohibited transactions, I just kind of went over it real quick. Definitely check that out. And if you have further questions, we'd be happy to help you. If you have a deal that you've already been thinking about doing or wanting to do, definitely give us a call and we'll be happy to help you. So lastly, we have our investment restrictions, which are very simple. Life insurance contracts, can't bank on someone dying, and collectibles, because collectibles, obviously, what is expensive to me might not be expensive to you. I could think a piece of art is really expensive, but to you, it could just be the red dot. So collectibles, you can't be investing those within your IRA. And that's it. Just those two things, really simple to remember. So what can you invest in with a self-directed IRA? Really easy. It's anything that you can take title to. These are some of the investment choices that we have. We break them down into our real estate, private entities, and notes, those three ones. With real estate in your IRA, it's going to be that direct purchase of real estate where your IRA is taking ownership of it. Private entities, you could be investing in an LLC, a private company that's a startup, a trust, that kind of stuff. A promissory note, which is what we see a lot of people do. They do loans secured by real estate. We've seen it secured by medical equipment. The sky's the limit. If you can dream it, you could probably do it. And then, of course, we have a transactions department for each type of investment. So whichever one that you have, if you have any questions about it, you'll be working with a transaction specialist who specializes specifically in each one of these investments. So they'll be able to assist you with any questions you have, reviewing the documents, making sure that everything is correct. It's really important to keep in mind, though, that we're not licensed securities agents. We don't sell you investments. We let you guys choose your own investments. And we as a custodian, we just allow you to invest in non-traditional assets allowed by the IRS. So what does your journey at Quest look like from opening an account to funding an investment? So first, of course, you would call us, or if you see us somewhere, you can come into the office, make an appointment. You would open up an account at Quest. You'll speak with one of our IRA specialists. They're going to go over what type of account you should have, answer any questions you have, and then help you with establishing that account. It's really easy. You can do it online with our electronic system, or if you're the paper type of person, you can also print it out and write it down and send it to us. Once your account is established, we will help you with funding your account. So if you are moving funds from another custodian, you're going to work with our transfers department. They're going to help you with transferring your funds in, requesting those funds from the other custodian. If you are somebody who's just starting to establish your account and you want to make that contribution, it's also very easy. You can do that online. You can write a check. And then once your funds are here and you locate your investment, again, we're not going to help you find those investments. We have to remain a neutral third party. You will find your investment. You'll work out those deals. You'll negotiate it with your borrower, lender, whatever you're doing. And then once you have all of that, you'll send the completed forms and documents to our transaction specialist. They're going to help you complete your investment forms, make sure everything is correct. And then when it's all said and done, Quest is going to fund the investment, and now your IRA is going to hold it. And if you have any questions, we'll be here to help you. So throughout your time and throughout your journey, you can always call and ask to continue to speak to that transaction specialist if they have any further questions, if you need any bills paid or anything like that. You can always just pick up the phone. We always have a live person answering it. So let's switch gears a little bit and go over a real estate case study so that you can see how an investment like purchasing real estate in your IRA really works. So John Wood and his associate Jay Wright want to purchase an office condo for $250,000 within their SEP IRAs. John and Jay, the two clients, they locate the property they want to invest in. It was a commercial office space type building, one of those doctor's offices where you have like a pediatrician, a dentist, doctor, that type of building. So they wanted to fix, flip, or hold it as a rental. So they transferred $150,000 from their IRAs into their Quest SEP IRAs to purchase the property. And notice that they moved in a little bit more than the actual amount as they anticipated doing some rehabs, closing costs, and it's always a good idea to have reserves in the account for anything that could happen in real estate. So John and Jay make an offer on the office condo in the name of the SEP IRAs. So again, the investing is going to read Quest Trust Company, FBO, John Wood, his IRA account number, and then Quest Trust Company, FBO, Jay Wright, IRA, and then his account number. John and Jay each complete a direction of investment for real estate. They send the direction of investment and the contract, which has been signed, read and approved by John and Jay to Quest. Since Quest is the one signing on your behalf of your IRA, the read and approved is actually a really important step for you as the client, because that is you telling Quest that you've read and approved the document that Quest can sign on your behalf. So that is a very important key when you're funding investments, that you do need to read the documents and approve that Quest can sign on your behalf. So Quest signs the contract and sends the title company along with the earnest money deposit of $10,000 from each SEP IRA. So it's a 50-50 split. It's going to be $5,000 from one and $5,000 from the other. At closing, John and Jay review all the documents and the title company sends them over to Quest for signatures. Quest signs the closing documents and wires the funds from the SEP IRA to the title company for closing. The title company records the deeds, and the two IRAs are now the owners on record as follows. So again, there's the vesting, but here you have as to an undivided interest 50% because they purchased the property 50-50. This is a way for us to know how the ownership of the property. So when you have checks getting sent back, this is how we're going to split the checks. It's going to come 50-50 from each account. John hires a property management company to oversee the unit. The management company finds a tenant to lease the unit. They take care of the rents and expenses. Those are handled by the property manager. And the office condo has a positive monthly cash flow of $850,000. So for $850. So $425 going back to each SEP IRA. This is a little bit lower, and because John and Jay were able to actually negotiate with the person because they wanted to be able to do some rehabs. They were doctor, they wanted to do their own rehabs. So that's why the monthly cash flow was a little bit lower, because the doctor ended up paying for their own rehab. So again, this is how you can negotiate your own deals with your borrower or your lender. That's completely up to you. The property management company submits the net rents proceeds to Quest for the benefit of John and Jay's SEP, and then John and Jay track their accounts via the client portals. We have a very easy online system, so you can monitor your account. You can check all the deposits that are coming in. We have that all listed on your account. 2 years later, the tenant offers to purchase the property for $395. So similar, $95,000. So similar process. A sales contract is prepared for $395,000 and submitted to Quest for signatures after having been signed, read, and approved by John and Jay, as well as completing a direction of sale for real estate. They are able to review and approve all the closing documents, and Quest signs the documents and returns them to the title company. The proceeds after the closing costs are then wired back to John and Jay's SEP IRAs at Quest. So all in all, the initial cash investment was the $125,000 with the cash flow over 26 months of $11,050, and the gains from the sale at $62,500, with the proceeds of each SEP IRA after the sale at $198,550. That's a tax-deferred gain of $73,550 over 26 months. I don't know about you, but that looks like an investment I would definitely want to make in my self-directed IRA. So some of the key points to remember is John and Jay's IRA will continue to pay no taxes on the gains, and they can reinvest that full amount of their profits on their next deal because the funds just went back into their SEP IRA. They didn't take a distribution or anything like that. They're able to now continue to use that money for investing. If the accounts involved were Roth IRAs, a Roth 401k, or in some cases an ESA or an HSA, the gains are going to be completely tax-free forever. John and Jay are in total control of the process from beginning to end, but Quest is the actual buyer and seller of the property. So John and Jay were still able to negotiate their deals and approve all the documents, but Quest is the one who actually finalized it by signing it on their behalf. John and Jay did not take money from their IRAs to buy the property and put the money back into their IRAs. The IRA was simply bought an asset and then later sold it for a profit. So John and Jay never took ownership of that money or anything like that. The IRA owned the investment and then the IRA sold the investment. So all the profits went back in there. IRAs can partner with other IRAs or even non-IRA money. So in this case, it was just 2 IRAs, but if they wanted a third person, again, they could have had a person and it didn't necessarily have to be an IRA. All expenses and proceeds must be split in accordance with their ownership percentage. So how the funds went out is how they come back. So in this case, it was 50-50, but if it was a 40-20-10 split, it would come back in that exact same way. The same way it goes out, it's the same way that it comes in. So John and Jay didn't have to have a property manager. They could have had the borrowers make those payments directly online via our online portal. But in this case, John and Jay wanted to have a property manager because, they had jobs, they had things they needed to do, so they hired someone. But if they didn't want to, they could technically do it themselves. As long as that money wasn't going into their personal account, it was still just going to the IRA. Again, we also have classes. So Nathan Long, our president, he teaches a class called Buying Real Estate in an IRA. I would definitely suggest checking this out if this is something that you're interested in. It's really educational and it goes over sticky situations and how to solve them. It's very interesting and I would for sure check that one out. So let's switch gears a little bit and go over private financing with a self-directed IRA. What if you're someone who has an IRA and maybe you don't want to be fully involved in real estate? Maybe you have a job or other responsibilities, but you still want to gain some of the benefits that come from investing in real estate right now. How can you profit? Maybe you're a borrower looking for some money and you want the ability to negotiate some of your deals, right? If you go to a Chase Bank and you say, hey, I need a loan and I want to negotiate some of those terms, they would probably laugh at you. But when you're borrowing from a private lender with other people's IRAs, you have the ability to discuss the terms of the investment since you're dealing with private funding. So how does using other people's IRAs work for building wealth? So the lender loans the money from the IRA to the borrower. Again, Quest doesn't help you find those deals, so you will have to find, if you're the lender, you will have to find the borrower or vice versa. You're the one who finds the deals. You're the one who's going to negotiate that with the borrower. You're the one who's discussed all the terms. You're going to draft the documents. And then when you're ready, Quest is going to review them for you and then fund the investment. And now the asset is in your IRA and you're receiving those payments for the loan, for the term of the loan. Once the borrower pays off the loan, the funds go back into the IRA with the terms that you decided on, and then you can continue to use those funds for another investment, getting all the tax savings and benefits that we talked about earlier. If you ask someone today, right now, if they had money to borrow, they're probably going to tell you, I don't really have any money that you could borrow. However, if you did ask them if they have a traditional or a Roth or an HSA or a SEP, chances are that they do, and they have money saved up in there. A large percentage of people probably don't know or aren't even happy with what they're invested in, like the stock markets. They just don't know that there's a whole world of things that they can invest in that they might already be the experts on. They just don't know that they can do that within an IRA. There is 24 trillion in retirement accounts with only 8 trillion in IRAs, and only 2% of that is being self-directed. So it's actually exciting to think about how much money is really out there for you to find and use for creating your own wealth, and how much you can diversify your assets and investments. So why should you be a lender or a borrower? Well, from a borrower's perspective, it's going to be a fast way for you to obtain funding for your deals. Especially if you already have your lender and you've already agreed upon the terms, you can fund your deals really fast. With a traditional bank, you have all that paperwork that you have to go through. With private funding, if you already have those terms done, you can draft those documents and you can get that funded right away with Quest. There's trillions of dollars in IRAs to fund your deals. Y'all, the sky is the limit. There is so much money out there. You just have to go out there and find it. That's why it is so important to work with companies like Quest, because not only are you getting the education, but you're networking and meeting other like-minded investors and borrowers and lenders. You have the ability to negotiate terms and the terms of your loan. And because of that, you could potentially have a lower interest and points than you would if you had a hard money loan. From a lender's perspective, if you lack the time to manage active real estate, you can, again, be loaning your money and having a passive role, but still gaining the benefits from investing in real estate. You have the ability to control your terms of your investment, and that's between you and your borrower, so you can negotiate that completely. Secured notes are a relatively safe investment. Most of our clients, when they're doing these types of loans, they use the property as a collateral for the loan. So similar to the way a bank would work, right? If you were to go to a bank and you wanted to borrow money for a house, if you didn't pay back the bank, what would the bank do to get recourse for their money? Well, they would take your property back. So the similar way, if you're using your IRA like a bank, you want to structure it in a manner that will protect yourself so that if your borrower weren't to pay you back, you could take ownership of the property, and now your IRA would potentially be the one taking ownership of the property. And then lastly, no toilets and tenants in mailbox money. Again, real estate is a great way to be lending is a great way to be involved in real estate without having to actually be the person who has to be finding someone to fix the toilets and dealing with the tenants. You can have more of a passive role, and you can be lending your money to an investor who maybe that is his job and that's what he wants to do, but you can still be gaining those benefits. And again, it goes back to that social investing and investing in your community, because if you're helping your community by lending your funds to an investor, not only are you growing wealth, but you're improving your community, which is an amazing thing, especially at this time where we should all be coming together more. So what can Quest do for you? We can help you grow your wealth completely tax-free. We give you access to networking opportunities leading to millions of dollars in investments. We have fast and friendly service with no expedited fees. And of course, we provide you with valued ongoing education to keep you on course. You can find all of our classes online. They're all linked here if you go to our website. And of course, we post all of these on Facebook. We are constantly posting things, so definitely follow us on Facebook, LinkedIn, and see what we've got going on over there. Quest doesn't stop there though, guys. We have multiple free webinars each week. Like today, we've got our weekly webinar. We also have Self-Directed Ira Saturday, our $1 trillion investment mixer, and then our 1,000,001 happy hour. Now, if you're a lender or borrower, I would definitely suggest checking out this 1,000,000,000 happy hour. You are able to pitch your investments. So if you have one, if you're looking for one, definitely attend, because you are able to network with people and to get your investment out there and potentially find someone. You can always ask for an IRA specialist for help. We've got our live chat feature, phone calls, emails, however you want to get in contact with us. Again, just give us a call. We're always there to answer your questions. Consultations are always going to be free. We love providing you guys with education. And today, lastly, we have a promo going on. So if you sign up for an account today, you can establish as many as you want for $100. Normally it's $100 per account, but today we're doing completely unlimited accounts for $100. Or if you open up an account and you contribute $100 or more before December 31st, we'll waive your account opening fee. So if you've been thinking about opening up that HSA, that ESA, that Roth, and making that contribution, now is definitely the time to do it, because you won't even have to pay a fee if you make that contribution. And this is where you can find all that information, where you can give us a call, where you can set up your account. You can contact us if you have any questions. Again, my name is Jo Ficca. Thank you so much for watching my presentation today. I hope you all have an amazing holiday and happy investing.
Awesome. Thank you, Joe. Everyone, I'm actually putting those emails and the coupon code there on their chat box. So if you want to take advantage, please give us a call whenever you get a chance today, or email iraspecialist@questtrust.com, and we'll get a consultation going as soon as possible with the next available specialist at your convenience and go over all the questions. I believe, through the presentation, Steve and I were answering a bunch of questions here. So thank you, Joe, for your time. Thank you for your expertise and everything. And again, everyone, please be safe out there. Have a great rest of your week. And we hope to be talking to you soon here on the phones. So thank you, guys. Thanks, Joe.